In this video, we are going to talk about difference between a bull and bear market, so before starting this video, please like this video and subscribe to our channel for the future updates. A bull market is occurring when the economy is expanding and the stock market is gaining value, while a bear market is in effect when the economy is shrinking. Let's take a closer look at these two types of markets and their relevance for your investing strategy. Here's the description of the difference between a bull and bear market. Let's start. Predicting market for investment purposes. Predicting markets for investment purposes is a tough call for anyone, including market veterans. So, to make the most of both phases, investors can invest gradually in a calibrated way that does not lead them to suffer steep losses. If someone started an SIP of 10,000 Indian rupees in one of the oldest equity mutual funds, HDFC Flexi Cap Fund, in December 1999 and kept investing even during bearish phases of 2008, 2014, 2015, and 2020, the value of the investment would have grown to 334 Indian rupees lakh by May 31, 2022, as compared to 141 Indian rupees lakh in Nifty 50. This is because the value appreciated due to the rupee cost averaging feature over the long term. In SIP mode, irrespective of the market condition, an investment of 10,000 Indian rupees was made monthly and a number of units were purchased. These appreciated over the years. Effectively, during the bearish periods, more units were bought, and during bullish periods, the value grew. Therefore, while investing, do not worry about which phase you are investing in, as long as you invest for the long term. That should be your core objective. Markets rise and fall in phases of bull runs and bear periods occur. How you maneuver the journey will determine whether you are going to emerge a winner or a loser. Strong returns. If you had considered buying ICICI Bank, which was a fundamentally strong company, it would have delivered strong returns. The price of ICICI Bank, Graph 3, in December 2019 touched 549.4 Indian rupees, then it tanked to 284 Indian rupees by March 2020 but gradually again scaled to 674 Indian rupees in February 2021 and rose further to 841.7 Indian rupees by October 2021. Later, it did slip in March 2022 to 653.8 Indian rupees and again gradually progressed to 747 Indian rupees in April 2022. Overall, if you notice, the value of ICICI Bank's share has progressed gradually to remain in the range of 500 plus levels over a year because of its strong fundamentals. So, this is the fruit which you got for taking the opportunity if you had bought in 2017. What strategies may work in a bull versus bear market? The ideal investment mantra is to buy low and sell high. That means you should usually buy in a bear market and sell in a bull market. However, we generally see investors flocking to equity markets in a bull run and can exit only during the next bull run to make profit from their investments. Most of the time, investors lose their confidence and exit in the bear market itself by booking losses. But there is a caveat involved. Selecting a stock based only on its price during a bear phase, without checking the fundamentals of the company, can be misleading. When you buy in a bear market, you need to understand whether you are catching a knife or mango. This means that one should always look at fundamentally strong companies while purchasing a stock in a bear market, otherwise you might end up catching a stock that is more like a falling knife. Example, Kingfisher Airlines. The stock of Kingfisher Airlines in 2006 was at 76 Indian rupees and later in 2007 it reached its peak of 300 Indian rupees plus only to fall drastically and never recover. In the end, an investor would have lost all his money because the stock was delisted on May 30, 2018. This is a classic example of a risky proposition which resulted in a permanent loss because fundamental details of the company were ignored at the time of investing in it. Ideally, an investor should have checked if there was value or not in the stock before buying. How should you invest in a bull versus bear market? Growth stocks in bull markets tend to perform well, while value stocks are usually better buys in bear markets. Value stocks are generally less popular in bull markets based on the perception that, when the economy is growing, undervalued stocks must be cheap for a reason. How you invest in stocks in bull and bear markets depends mainly on your time horizon. If you do not need the money for decades, then it matters little whether the market is currently bullish or bearish. As a buy and hold investor, you probably shouldn't change your investing strategy based on prevailing market conditions. The stock market can be bearish even while bull markets are occurring in other asset classes, and vice versa. If the stock market is bullish and you're concerned about price inflation, then allocating a portion of your portfolio to gold or real estate may be a smart choice. If the stock market is bearish, then you can consider increasing your portfolio's allocation to bonds or even converting a portion of your portfolio into cash. You can also consider geographically diversifying your holdings to benefit from bull markets occurring in other regions of the world. Regardless of the current state of the stock market, it's important to stay focused on the long-term prospects of the companies in which you are invested. Companies with great business fundamentals are likely to produce significant returns for your portfolio over time. How do bull markets and bear markets differ? Stock prices are rising in a bull market and declining in a bear market. The stock market under bullish conditions is consistently gaining value, even with some brief market corrections. The stock market under bearish conditions is losing value or holding steady at depressed prices. Rising GDP denotes a bull market, while falling GDP correlates with bear markets. GDP increases when companies' revenues are increasing and employee pay is rising, which enables increased consumer spending. GDP decreases when companies' sales are sluggish and wages are stagnant or declining. Bear markets are closely linked with economic recessions and depressions. Recessions are formally declared when GDP decreases for 2 consecutive quarters, while depressions occur when GDP decreases by 10% or more and the downturn lasts for at least 2 years. A declining unemployment rate is consistent with a bull market, while a rising unemployment rate occurs during bear markets. During bull markets, businesses are expanding and hiring, but they may be forced to lower their headcounts during bear markets. A rising unemployment rate tends to prolong a bear market since fewer people earning wages results in reduced revenues for many companies. Price inflation may be a problem when the economy is booming, although inflation during a bear market can still occur. High demand for products and services in bull markets can cause prices to rise, and shrinking demand in bear markets can trigger deflation. Low interest rates typically accompany bull markets, while high interest rates are associated with bear markets. Low interest rates make it more affordable for businesses to borrow money and grow, while high interest rates tend to slow companies' expansions. How long do bull markets last? The average bull market has lasted 6.6 years and gained an average total return of 334%. Most recently, the U.S. stock market was in a historic 11-year bull market. Stock prices rose more than 20% in 2009 and continued rising until March 11, 2020, when prices plummeted amid concerns about the coronavirus and falling oil prices. While it's impossible to know how long our most recent foray into bear market territory might last, we do know that historically the market has recovered and grown after every downturn and that bear markets generally last much less time than bull markets. And what's a bull market? Bull markets can be even more loosely defined as periods of consistently rising stock prices. But many people recognize them as the inverse of bear markets, i.e., when major indexes rise at least 20% and continue upward without falling by more than 20% from recent highs. Before it entered bear market territory, the U.S.'s most recent bull market saw incredible highs and more than recovered from the bear market of the Great Recession. In fact, from March 9, 2009, the bottom of the Great Recession, to the last high of our most recent bull market, the S&P wink with tongue sticking out 500 had risen over 400%, more than recovering from its preceding bear market losses. Translation: if you had $1,000 in an index fund that tracked the index on March 9, 2009, you'd have grown that to more than $4,000 without adding another cent yourself. Not bad, eh? What's a bear market exactly? In general, a bear market is widely recognized as a period when major indexes such as the S&P wink with tongue sticking out 500 stock index, which tracks the performance of about 500 large U.S. stocks, and the Dow Jones Industrial Average, which includes 30 of the largest U.S. stocks, drop by 20% or more from a recent peak and stay that low for at least 2 months. Since 1926, we survived at least 8 bear markets, according to financial advisory firm First Trust. One bear you probably remember all too well. Between October 2007 and March 2009, the S&P wink with tongue sticking out 500 tumbled by more than 50%. On March 11, 2020, due to investor anxiety over the coronavirus outbreak, the Dow plunged 5.86%, or 1,464 points, sending the index into bear market territory for the first time since 2009. It was a drop of more than 20% from February's record high. The S&P wink with tongue sticking out 500 and Nasdaq also dipped by 4.89% and 4.7%, respectively, about 19% below their recent all-time highs. On March 12, all three major stock market indexes ended the day in bear market territory, with cumulative drops of over 20%. The good news is that each bear has typically lasted for just a little over a year, and stocks have always recovered, historically, and gone on to make significant gains. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.